not generating enough wealth. So instead of generating wealth, we're printing money. We basically adopted MMT as our new economic engine. Well, you can't print prosperity, and that's all going to come back to bite us. And so it's just a matter of when, I think, when the dollar basically gets weaker. So, and I think that's going to help gold.
Welcome, everyone, to another episode of Inside the Markets presented by StockPulse.com. We are honored to be sitting down today with Don Durrett. Don is the proprietor at goldstockdata.com. He's an author, investor, and website owner. Thank you, Don, for joining us today.
Yeah, thanks for having me on. This is the first time.
Yes, it is. And we are pleased to be able to ask you some questions, particularly about the gold and silver markets, I think. So let's start there. There's been a little bit of a bump in the gold and silver prices lately. What's causing that, and will it be sustained?
Yeah, it's a good question. I'll try not to take too long to answer it, but that's a question I could spend, 10 minutes easy on. So I follow gold very closely and the factors that impact it very closely. And so right now, it's really, we've had a 13-month, now going on 14-month correction in gold, and we've been in a channel. So we went all the way up. So we broke out. We peaked in August. So I'll just stay there at the peak. We peaked in August in gold at $2,075. And then we went all the way down to 1680. And we've touched 1680 three times. So we have this pretty strong channel. And I actually lower the channel not all the way up to 2075. I bring it down to 1950 because we've actually we went down below 1950 and we retraced up to 1950. So that kind of created the channel. So the channel is 1680 to 1950. So we've been in it for about 14 months. Now, I don't think that this bull market that actually began in the summer of 2019 for gold when we broke out at 1370, I don't think that bull market is over. So we basically ran from like July 2019 from 1350, 1370 all the way up to 2075. That was quite a run. I don't think that run ended in August of last year. I think that we are in a correction. And so that correction of this channel that we're in, we've had what I consider a kind of a rinse and repeat cycle. So we go in the channel, and again, we've been down to 1683 times. So we basically go up and down. We go, up and down in the channel, and we can't break out. And I've been bearish all this year since kind of late January, February, that gold was kind of stuck. And once we got to, and the reason why it was stuck is because investors were going to put their money into the stock market, and until the stock market stopped trending higher, they're not going to buy gold. It doesn't matter what the dollar does, doesn't matter what inflation does. You have to get people to move their money out of the stocks, out of bonds into gold. And so I thought that once we got to September, it started to open up a little bit. So we had September, October, November. So we've had 3 months here. And it's getting to the point where everything goes in cycles. So we're getting to the point now where gold is trying to make another one of these runs back up to 1950 if it gets there and then out, or if we rinse and repeat again and we go back down. Now, if you look at the chart from August, the gold chart, especially the weekly gold chart from August until now, it formed a flag, and last week it actually broke out of that flag. So technically, right now everything looks really good for gold. And a lot of people say that we are breaking out here, but I'm more in the camp where once you get above 1850, it gets exciting. It's the excitement zone, but it's not the breakout zone. So the breakout zone is 1950. So we're in the excitement zone, but we still have to be patient. And the reason why we have to be patient is for two main reasons. Reason number one is the big one, is the stock market is still trending. Today, the S&P hit 4,700 for the first time ever, I think, an all-time high. So the market is still really red hot, and we're still trending high. And I think it's going to roll over. I think it's topping. I could be wrong. Maybe we go another, 3 to 10 months of this, this melt up, this really strong risk on trade. But I think that so people, and so that's the main reason why, to be a little bit, not so bullish that we've broken out here, because of that strong market. If that stock market still stays strong, and that ties in with my second reason why to be kind of hesitant and say, oh yeah, we've broken out, it's off to the races. And the reason why the other reason to be hesitant is that the bankers basically do not want gold to break out. The bankers will defend gold. They don't do this publicly, of course, and a lot of people say that what I'm saying is a conspiracy, and it's not true. But if you watch the gold charts, yesterday was a good example. Gold tried to trade yesterday above 1360 like 3 times, and every time it did, it got hammered down. Now, it's almost as if somebody had put a cap at 1360 and said, you shall not go higher. And I've seen this over and over again. And, basically, I call them the banksters. They have two things that they do to prevent gold from breaking out. One is the capping process, which we saw yesterday. And the second one is the beatdown process. Usually and they do either one, and then they do them together. So they take their time and they wait, and then if it's time to do a beatdown, they'll do it, and if it's time to do a capping, they'll do the capping. So right now we're kind of in a capping, and so in order for us to really start trending and get above 1900, we still have to battle the banksters, this capping beatdown process. Somebody has to buy the dip. We're going to see it. We're going to see these beatdowns, and the reason why I call them beatdowns is that whoever does them, they actually have to sell billions of dollars of paper contracts in very condensed periods of time, like over, 5 minutes, 10 minutes, 20 minutes. I mean, they basically dump billions of dollars. And a lot of times it happens over 1 and 2 minutes. So the only way that computers can all do that, the computers are all basically looking for the trend and then down. But we see this happen. I've been watching this for a decade, over and over again, these basically timed events, these timed beatdowns. And one of the things that happens usually is when you get one of these beatdowns, and they usually happen at the opening, in New York opening, is that they don't get bought. So you'll go down $20, $30, and then it'll just stay down there for the rest of the day. And that'll be a successful beatdown, basically. And so what were the period that I'll finish up my answer here. We're getting into a period now where we're in this kind of this excitement phase from 1850 to 1950. We're going to see a couple of beatdowns here in before the end of this month, but definitely in December. And we're going to see if that dip gets bought or not. If it gets bought, then maybe we're going to break out here above 1950, and it could be off to the races. And there's tons of factors that come into play here. I mentioned 2 reasons to be hesitant, but there's a whole array of macroeconomics that impact why people want to buy gold. And so, I can't sit here and keep talking over and over and over again, but I'll finish this up. But it's a complex thing. What impacts the price of gold?
How about on the miner front? What is the HUI, which is an indicator that you keep an eye on, an index, and what does it imply for the miners index currently?
Yeah, so the HUI is the index that I follow very, very closely, and it got all the way up to 320 after the breakout of 2075. And I was saying that it was a fake. It was basically a false breakout. That don't think that this is going to keep going. I said that we're going to go below 250, and probably somewhere between 200. it actually went from 320 down to 250 very quickly. It didn't take long. And then I said, once it got to 250, I thought that we should look for a bottom somewhere between 200 and 220. And we actually got down to 223. And I said the time to buy was probably once we got to 230. So the HEI today is about 275. And so we were all the way down to 223. And that's when I was kind of buying the dip. I bought the dip at 230 and below. And then we bounced off. We didn't go all the way down to 200. And I think the reason why we didn't is because the stock market didn't crash. It didn't really correct. It didn't correct 10%. It only corrected like 5%. So right now, the HUI is signaling that we're probably going to break out here because we've bounced off of that 223 all the way up to 275. That's a pretty good bounce. So for me, what I look at is 250 on the HUI for me. Anything above 250, and this is for the correction right now that we've been in, this 13, 14-month correction. Anything above 250 is bullish. Anything below 250 is bearish. So we want to stay above 250. If we stay above 250 here, then we have a really good chance of breaking out. And so that's kind of what I'm looking at. Above, we go back below 250, it gets a little nerve-wracking because then we actually bring some of these lower lows into play. Then, we could go back down to 230, 220, 200. That's a possibility. So I really want to, and then in tandem with that HUI, I keep focused on that 250. I want to stay above it. The other number is the price of gold. So the thing that really impacts that the miners by far is the price of gold. So I mentioned 1680 has been touched 3 times during this correction. So I don't think we're going to retouch it. I think 1680 is the bottom, and I think it's going to hold. I don't think we're going down there. But we could go back down into the 1720, 1740 range during the next correction. So what I think is going to happen, I think we're going to get a correction in the stock market before the end of the year of at least 5%. And when that correction hits, it's going to be interesting to see what happens to the price of gold, if it gets a bid, and the HUI. Does 250 hold on the HUI? And so if we go down to 1740, I don't know if 250 on the HUI will hold or not. It might not. It'll be, could easily break. HUI could go a little bit lower than that, but we might not go down to 1740. Maybe we only go down to 1770, or even higher than that, and then the 250 holds, and then at that point, I don't think that the stock market is going to get a bid. What I mean by that, I don't think that the stock market is going to do what it just did after that 5% correction in September. So we have the 5% correction in September, and then the market got a bid in October and basically went all the way back to an all-time high. I don't think that's going to happen this time. I don't think the market's going to get a bid. I think it's going to basically be a topping process. I could be completely wrong. And I base all that on inflation. And I just think inflation is going to be higher next year. And I think that the stock market is basically going to hit a ceiling here. And the stock market's going to is basically going to have trouble getting a bid based on a weak economy in 2022, which is my expectation.
You said, if I'm correct, the stock market's melting up in a way.
Yeah, right now, yeah.
Does that precede a meltdown in your opinion? And if so, do you have a timeline or do you have some indicators that might clue you to a time?
Yeah. So I've talked a bit about the timeline. I basically said I think we're having a topping process now in the stock market, but it could easily go another 3 to 10 months just because the markets stay rational longer than you can stay solvent, right? They just stay irrational. But I think that the market right now is basically overvalued, overbought based on the fundamentals. So let's look at the fundamentals. You have a supply chain problem we've never experienced ever. This is the first time that in America, we've ever had store shelves empty. This is the first time ever where you go to get your car fixed and the guy says, I can't find your part. I can't find it anywhere. Never, ever has that ever happened. I've had people, had get into car accidents and then have to wait to get their car fixed because they can't find the parts to fix the cars. Never. I mean, and this is just one example. I remember I heard this one guy, he had a business, and his business was glass, so replacing windows and stuff like that, installing windows. And his business literally shut down because he couldn't get any glass. I mean, this is insanity. Used cars right now, they're not making enough new cars because there's not enough chips, and so used cars are up like 25%. Never, ever in our lifetimes have we seen stuff like this. People cannot find workers. There's a shortage of workers right now. That's never, ever happened. Not across the board like we're seeing right now. These data points point to something different, a new normal, if you will. And the stock market is priced in that COVID's going to end, and I think COVID will end by early next summer. I think COVID will be basically gone by June. And everybody's pricing in that once COVID's gone, that the economy is going to roar back to life. Well, I don't think it's going to for two reasons. One, I think inflation is going to hamper consumer spending, is going to hamper profits, and I think corporations are literally going to lay people off instead of hire people once inflation doesn't go away. So you have that basically impacting the economy, and then I think that the supply chain thing is going to extend. I don't think the supply chain problem is just going to, for instance, Long Beach right now, they can't offload those ships fast enough. It'll probably take until June to do that. But I don't think the supply chain things are just going to go away once they clear out, all those boats in the harbor. I just think this is a transitionary period. I think there's going to be a food crisis next year. I think the food crisis is going to be a combination of high prices and basically sometimes things that you just can't get. And so I think that this is a transitionary point for the U.S. And I mean, if we look at our political system is definitely fractured, where you have two political parties that don't get along, and it's not getting better, if you will. It seems to be getting worse. So politically, it's going to be really, really difficult to address these problems. And here's another one for you. I do not. Next year is an election year. I do not think that Congress, especially the Republican Party, for instance, the Republican Party in the House, they were the reason why that infrastructure bill passed was because the Republicans, basically 11 Republicans, voted with the Democrats. I don't think the Republicans are going to be in a mood to basically help the Democrats pass anything in an election year. And it's going to be really difficult for them to stimulate the economy next year. I read yesterday on Twitter, somebody said that the Democratic Party, somebody is trying to do another stimmy. Somebody wants to do another stimulus check out. We need to get another stimulus check out, right? So next year, I think it's going to be really difficult for them to get more stimulus. So the stimulus is coming off to a large extent next year, and that's going to hurt the economy. So one final thing on, why I think the economy is going to be weak is inflation in China is higher than it is in the United States. And so that inflation, we buy a lot of things from China. That inflation is going to flow from China to the U.S. So we have inflation in rent in here, double digit, I think, rent inflation. We're going to have double digit inflation in food. We're going to have double digit inflation in energy. And now we're going to have possibly double digit inflation on products coming from China. So it's going to be across the board kind of thing. So next year to me looks, I think worse economically than the last 2 years. And the only reason why the last 2 years were so, stable, if you will, is because of all the stimulus.
How bad in 2022 do you think inflation of the US dollar could get?
Yeah, so I think there's going to be a big inflation in food. So I think we're going to see like double digit inflation. So I'm thinking, some people say that we peaked. Inflation has peaked. We're like at 5% right now, CPI. I think we go higher. I think that next year, I think we're going to see the CPI get to at least 8% is my guess. I could be completely wrong. Um, Most people say we're already at 8% and the government's just, not, the whole number isn't there. But I think we're looking at, the CPI. And if the CPI gets, 6, 7, 8, I think that that's going to be really damaging to the economy. So maybe my 8% number is way off. Maybe we won't get that high. A lot of people say it's transitory. There's no way that this high inflation is going to stay. It's going to stick. But the one thing that we've seen is that once prices go up, they tend to stay up. Um, and so it's going to be, is this a one and done thing? We basically add all these prices. We go up 10% and then all of a sudden it just goes back to 2%. I don't think so. I don't see us going under 5% for all of next year. So my range is 5 to 8. We'll see what happens.
What are you looking at on the dollar index?
Yeah, that's a great question. So I think the dollar index is really topping here. It's high today, 95.8, 95.7. It's really, really getting high. And that's really interesting. Why the dollar would be getting stronger at the same time that we're printing, this unbelievable amount of money. You would think the dollar would get weaker. But, it's because the other central banks are printing just as much as we are. And so the dollar index is, the big chunk of the dollar index is the euro. And the euro is, they're printing as much as we are. So we're not gaining ground. The dollar's getting stronger against the euro. And then the yen, Japan is also, they're printing a lot of money. So those are the two other big ones. And if if the yen and the euro aren't gaining on the dollar, then the DXY tends to trend higher. So we have the three biggest currencies in the DXY are those three. But I think that the dollar is weakening versus inflation. So maybe it's not weakening against other currencies, but it is against inflation. The dollar is getting weaker in that regard. As a matter of fact, 5% inflation is a very weak dollar, if you will. If you're losing 5% compounded, that's brutal. We stay at 5% inflation for 2 years. That's a really big hit on the dollar, right? I do think that the dollar is going to go lower. I don't see it getting, say, above 96, and we're at 96. So 96, 97, it just feels really, really overvalued here at 96, 97. I was wrong about the dollar. I thought it would close the year at 88. But the reason why is because I thought the economy was the risk on trade was going to flip the risk off, and that the stock market was basically going to be hemorrhaging in the fourth quarter. And it's not hemorrhaging; she's going higher. And so, one of the reasons why the dollar is stronger is a lot of money is going into the stock market, and a lot of money is still going into bonds. Those are really the two. There's really four main factors that kind of prop the dollar up. One is, foreign buyers buying U.S. assets, such as specifically, mainly stocks and bonds. And I said one and two is basically foreigners buying them. And then the other big factor is globally, the dollar is done in trade. And so if people are comfortable using the dollar in trade, right now, I think 60% of all foreign trade is done in dollars. So when countries are comfortable using dollars for trade, then that props up the dollar as well. And then the other one, when people are comfortable with dollars, they borrow money in dollars, which is, and one of the reasons is the banks want to loan it in dollars, because if they loan money in another currency, and let's say it's a third world country, and then that currency devalues, then they actually lose money. You actually want to borrow money on something that's inflating, right? That's why people are basically doing loans to buy houses right now, because of inflation. You actually want to borrow money when there's inflation. So people around the world, banks, they want to loan out money in dollars if they think it's a strong dollar. But if the dollar weakens, they're going to stop making those loans. And so we have fewer people making loans. And that's one of the reasons why the dollar is so high, because there's been a lot of foreign loans made to businesses that have to be paid back in dollars. And so you have a demand for dollars for that reason. So there's a lot of foreign demand for dollars for, ironically, for local loans made in dollars. So I don't know how long that will last, but I think what's going to happen is the United States has been the dominant economic system, the dominant economic player since 1945. Undoubtedly, I mean, we've dominated it, and we've become more dominant as basically the Soviet Union broke up and Russia lost its real, its strength as kind of a superpower. And then the United States from the 90s forward, and then China came on board, but China's currency has never floated. So the U.S. is kind of still kind of maintain its global economic dominance. However, I think that we are going to experience a flip where the global economic dominance switches and moves to Asia, specifically Southeast Asia, where you have Indonesia, Japan, China, India, South Korea, the Philippines, Vietnam, all those countries. They used to call them the super tigers. I think that is who is going to be the economic dominant area going forward. And the U.S. is right now, and I don't think people realize this, is really currently losing that position because we're not generating enough wealth. So instead of generating wealth, we're printing money. We basically adopted MMT as our new economic engine. Well, you can't print prosperity, and that's all going to come back to bite us. And so it's just a matter of when, I think, when the dollar basically gets weaker. So, and I think that's going to help gold.
What are the top stories of 2022? Or I'm sorry, what are the top stories of 2021 in your view?
Well, inflation, without a doubt. I mean, there's no doubt that inflation is well economically. I mean, is going to be inflation because if you go back to like early spring of the year, the Fed wasn't even afraid of inflation. They were saying it's transitory. You can ignore it. And then we got into the summer, and inflation picked up. So inflation, I think, number one. And then you have COVID, the damage. The other one, and this isn't really a story yet, it's more of a conspiracy theory almost, is that COVID has damaged the U.S. economy. That one is kind of a really underwritten about story. How much damage has COVID done to the economy? Right now, I mean, with the stock market as high it is, I mean, people don't even think it's done anything. But I think 10% of small businesses probably went broke. And 10% of small businesses aren't coming back. And then you have the whole supply chain thing. I think that's damage that COVID's done to the economy. But yeah, supply chain, that's another big story, absolutely. So we have some historic, we have these massive stories, right? Then we have these spikes in commodities, which we've never had, right? You got steel just going absolutely nuts, coal going nuts, you got oil prices going nuts. I mean, oil's at $80 and nobody's even, gasoline prices are now starting. That's becoming a story, right? There's story after story after story here, and everybody seems to think that we're going back to normal. I mean, these are some significant stories. 2021 is turning out to be quite the historical year, and I don't think the genie's really going back into the bottle in 2022. I think 2022 is going to have a lot of big stories, a lot of change. And I think what I talked about the U.S. economy kind of losing its dominance, I think that's going to be a big story next year. The dollar losing its dominance, the Fed losing control because they're losing control because they're number one. And this isn't a story yet, but I think it'll be a story next year. Their number one tool is basically flooding, or not, maybe flooding is too strong a word, but injecting liquidity into the economy. Injecting the liquidity, either buying treasuries, in the auctions, or buying bonds that are basically bad, or buying market-backed securities. These are all the Fed's tools to basically prop up the economy. But those tools are going to lose their strength and actually become net negative if you have 6, 7, 8% inflation, like I said. you have high inflation, then that tool basically breaks. Then at that point in time, they're literally going to burn down the printing press if they keep using it. It's like the printing press, the motor in the printing press can only go so fast. Of course, I'm using being metaphorical, right? Printing press can only go so fast before it burns up. And if you're using it incorrectly, if you, so next year is going to be one of the big stories for next year is going to be, that tool, how strong that tool is. Do they need to use that tool? Can they use that tool? And now they're talking about removing Powell and bringing in Brainerd. She might not get it, but if she gets in, I think she will be more dovish than Powell, and I think that she will be more aggressive to print, more aggressive to liquefy the economy versus let the whole, basically pull back on printing and increase interest rates to slow down inflation. I think they don't. I think they won't raise rates, even if inflation gets stays at 5%. Anything under 5%, I don't think they raise them. Um, we'll see. It's going to be real interesting to see the dynamics with inflation and raising rates next year.
We've had the honor of sitting down today on Stock Pulse's Inside the Markets with Don Durrett. He's an author, investor, and proprietor at goldstockdata.com. Thank you so much, Don, for joining us today.
Yeah, thanks for having me on. Appreciate it.
And thank you, everyone, for listening.